The financial system includes commercial banks, investment banks, pension funds, hedge funds, and mutual funds. Why do firms need the financial system? Firms need the financial system to facilitate short-term cash management policies and to accommodate near-term cash inflows and outflows. That is, to receive payments from sales, pay employees, pay vendors, and so on. Firms also need a financial system to obtain long-term funds. There are three key long-term management decisions that impact shareholder wealth: the investment decision, the financing decision, and the dividend decision. A good investment decision increases shareholder wealth by making investments that earn a return greater than a hurdle rate, that is, the cost of financing. A good financing decision is to obtain debt that complements the firm's assets and to use that debt in a proportion to equity that minimizes the cost of financing. By minimizing the cost of financing, a firm can make more good investment decisions. That is, as the hurdle rate, or the cost of financing, decreases, the number of attractive investment opportunities increases. A good dividend decision increases shareholder wealth by returning cash to shareholders when the firm doesn't have good investment opportunities. The financial system plays a role in all three decisions. Firms that require funds from external sources can obtain them in three ways: through a financial institution, through financial markets, or through private placements. Financial institutions are intermediaries that channel the savings of individuals, businesses, and governments into loans or investments. Almost everyone deals with financial institutions on a regular basis. Everything from depositing money to taking out loans and exchanging currencies must be done through financial institutions. Financial intermediaries provide a conduit between net suppliers of funds, on average individuals, and net demanders of funds, such as businesses and governments. Notice I use the word net. Younger, early career individuals may be users of funds by borrowing money for an education, a house, cars, etc., while older individuals are usually providers of funds. Overall, though, individuals are net providers of funds. Commercial banks, think Wells Fargo, Citibank, Bank of America, accept deposits and provide security and convenience to their customers. Commercial banks also make loans that individuals and businesses use to buy goods or expand business operation, which in turn leads to more deposited funds that make their way to banks. If banks lend money at a higher rate than they have to pay for funds and operating costs, they make money. Investment banks help firms attain long-term financing by facilitating debt and equity offerings, advise firms on major financial transactions such as mergers and restructuring, and engage in trading and market-making activities. A market maker assumes the risk of holding a certain number of shares of a particular security in order to facilitate the trading of that security. Prior to 1999, a bank could either be a commercial bank or an investment bank, but not both. The Glass-Steagall Act of 1933 created the Federal Deposit Insurance Program and separated the activities of commercial investment bank. This act was repealed in 1999 by the Gramm-Leach-Bliley Act. The shadow banking system refers to financial intermediaries involved in facilitating the creation of credit, that is, lending, much like traditional banks, but are not subject to regulatory oversight. These include investment banks, mortgage lenders, money market funds, insurance companies, hedge funds, private equity funds, and payday lenders, all of which are a significant and growing source of credit in the economy. The shadow banking system has escaped regulation primarily because it does not accept traditional bank deposits. As a result, many of the shadow banking institutions have been able to employ higher market, credit, and liquidity risk and do not have capital requirements commensurate with those risks. Subsequent to the financial crisis and the subprime meltdown in 2008, the activities of the shadow banking system came under increasing scrutiny and regulations.